Welcome, welcome, welcome. Good day, everyone. I want to believe that you are enjoying your holiday. Before we go into the topic of today, I'd like you to let me know where you are watching from, and I'd like to know the structure of your business. Is it a sole proprietorship, a partnership, or a limited liability company? And also let me know the nature. What's the business that you do? Well, I want to just let you know that you need to share this video. Please share it. It's educative for small businesses. Also, I want you to like it and, in fact, ask your questions, because your questions will throw more light and you will know more. Thank you once again for joining me this afternoon. My name still remains J. Tai Okupola, and I believe you are ready for our journey today. Do you know that the structure of your business has impact on the tax you pay? And so the topic of today will surely dwell on that. And the topic is tax efficient structure for startup businesses to make profitable income. So let's just go on. Navigating the tax landscape is a crucial aspect of managing finances for startups and small businesses. And that is why when you leave your tax out of your financial management, you are leaving one leg out, and surely one way or the other you will pay for it, because the time is coming that you have to pay tax. So with the right strategies, businesses can minimize tax liabilities and optimize cash flow, enabling them to allocate resources more effectively towards growth and expansion. So in this direction, we'll explore tax effective structuring techniques tailored for startups and small businesses operating, especially in Nigeria. So number one point we want to consider is choosing the right legal structure. Choosing the right legal structure for your business. Selecting the appropriate legal structure is the foundational step in tax efficient planning for startups and small businesses. In Nigeria, common legal structures include sole proprietorship, partnership, limited liability company, and company limited by guarantee. Each structure has its own tax implications, ranging from personal income tax for sole proprietorship to corporate income tax for limited liability companies. So assessing factors such as liability protection, ease of setup, and tax obligations is essential in making an informed decision. This time I'm talking to prospective business startup. You need to consider all these factors when you are setting up your business. You need to look at liability protection, ease of setup, and tax obligations. They are very, very important. So let's look at number two. Number two factors which you need to look at in this topic is leveraging tax incentives and exemptions. Leveraging tax incentives and exemptions. Nigeria offers various tax incentives and exemptions aimed at fostering business growth and development. Startups and small businesses should explore these incentives to reduce their tax burden. For instance, qualifying companies engaged in priority sectors such as agriculture, solid minerals, and infrastructure may benefit from pioneer status incentives, which grant tax holidays for an initial period of years. Additionally, businesses operating in designated pioneer industries may enjoy tax-free dividends and capital gains. They may enjoy tax-free dividends and capital gains. So by taking advantage of these incentives, businesses can preserve capital for reinvestment and expansion. The number one point is efficient capital structure. What type of structure, capital structure, do you want to put in place for your business? So how a business raises capital can significantly impact its tax efficiency. Startups often rely on a mix of equity and debt financing to fund their operations. While equity financing doesn't incur immediate tax obligations, it dilutes ownership. And may result in future dividend payments. However, this is subject to withholding tax. On the other hand, debt financing allows businesses to deduct interest expenses, thereby reducing taxable income. However, excessive debt may raise concerns about solvency and financial risk. So striking the right balance between equity and debt financing is crucial and important for maintaining optimal tax efficiency while safeguarding financial stability. Number 3 point is strategic location selection. The geographic location of a business can influence its tax liabilities. In Nigeria, tax rates and incentives may vary across states and regions. Some states offer preferential tax regimes to attract investment and stimulate economic activity. So by strategically choosing the location of operation, businesses can capitalize on favorable tax regimes and minimize overall tax exposures. Factors such as proximity to target markets, infrastructure availability, and regulatory environment should also be considered in conjunction with tax considerations. Let me tell you, I know companies, businesses set up in rural areas enjoy certain incentive than those set up in urban centers. So number 4 points we want to look at is compliance and record keeping. So ensuring compliance with tax laws and regulations is paramount. for avoiding penalties and sanctions. Startups and small businesses must maintain accurate financial records and file tax returns in a timely manner. Implementing robust accounting systems and engaging qualified tax professionals can streamline compliance efforts and ease the risk of non-compliance. In addition, staying abreast of changes in tax laws, legislations, and seeking expert advice when necessary is essential for adapting to evolving requirements and optimizing tax efficiency. The last but not the least, which is number 5 or number 6, I'm not too sure, is utilizing tax deduction and credits. Utilizing tax deductions and credits. May I let you know that the tax laws allow for what they call allowable expenses that you can incur and will be taken by tax authorities as a deduction from your income. So leveraging available tax deductions and credits can help reduce taxable income and lower overall tax liabilities. Businesses in Nigeria, businesses may be eligible for deductions such as expenses incurred wholly and exclusively for business purposes. This includes rent, salaries, utilities, marketing costs, and so many others. Furthermore, certain investment in research and development (R&D) activities may qualify for tax credits. Under the Nigerian Investment Promotion Commission Act, these are qualified for credits. So, by identifying and maximizing eligible deductions and credits, businesses can enhance their cash flow and profitability. Before I wrap up, I want you to know that if you are watching this on our YouTube, please subscribe and click the bell for you to be notified anytime we are having a new video. And I also want you to share this video, like it, and ask your questions. We'll appreciate your questions. It will provide more insight even to you and others. Please, even if you are watching replay, don't hesitate to ask your questions. So let me just wrap up by saying tax efficient structuring is a vital component of financial management for startups and small businesses. By carefully considering legal structure, leveraging tax incentives, optimizing capital structure, selecting strategic locations, ensuring compliance, and utilizing available deductions and credits, businesses can minimize tax liabilities and enhance their competitiveness in the market. So what do I need to do? Seek professional guidance and stay informed about relevant tax regulations that are essential practices for achieving long-term tax efficiency and sustainable growth. By adopting a proactive approach in tax planning and structuring, startups and small businesses can position themselves for success, especially in a dynamic business environment. Thank you for listening. Thank you for watching. And I believe this has provided an insight to you and to your business. Until I come your way next week, thank you very much. and I say peace out.